Welcome. My name is Nikki Johnston. I'm with Transition Advisors, and our webinar today is Mergers of Accounting Firms, Avoiding the Roadblocks and Understanding the Market. Before we begin, we'll need to cover just a few important items. First, please close all other programs you have running on your computer. This will help to ensure a quality presentation and reduce any audio issues that may come up. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you participate in all 3 of the polling questions that we'll have today throughout our presentation. Please note that GoToWebinar does monitor your participation in these polls. Next, you'll receive a link to an online evaluation. I'll email that to you this afternoon. You must complete that evaluation before I can email your CPE certificate of completion. Once both of the requirements are met, I will send you your certificate within 10 business days. There's an additional very brief survey that will pop up automatically once the webinar ends. And if you could take just a brief moment to complete that, it's not a requirement for NASBA, but it does provide us with information that helps provide you quality webinars and see what it is that you're seeking in these CPE sessions. In order for you to fully participate in today's webinar, please familiarize yourself with the GoToWebinar control panel. It should be on the right-hand side of your screen. There's an orange arrow near the top, and that's to minimize the control panel. During the presentation, all of the participants are muted, but you can communicate with us by using the question box, which is toward the bottom of the panel. Just type your question there and click Send. Questions are important to us, and we'd love to address any concerns that you have. Our presenter, Joel, will take questions at the end of the presentation today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include understanding what your partnership agreement should include and tax season implications for M&A of accounting firms. For a complete list of our webinars and other webinars that are taught by the folks here at Transition Advisors, you can visit our website. With all of that said, it brings us to our first polling question. So just a reminder that the polls are required. The first one today is a pretty simple question. How many partners are in your firm? So we'll leave the poll open for about 30 seconds. Take time to answer here. It's either 1 to 2, 3 to 8, 9 to 20, or 21 and above. And we'll wait just a few more seconds, so go ahead and record your answer if you haven't already. All right, I've closed the poll. We'll go ahead and share the results there. So Joel, it looks like 77% of our attendees, there's 1 or 2 partners in their firm, and then the rest have 3 to 8 today.
Wonderful.
All right, and with that, I'd like to introduce our presenter for today's session. Joel Sinkin is the president of Transition Advisors. Thank you very much, and I hope you all enjoy the webinar.
Thank you so much, Nikki. And let me get this show my screen here. Okay, everybody, welcome. For those of you who've heard me speak before, welcome back to Elm Street. I remain Freddie. We have a very unique group today in that almost everybody are smaller firms, and we're going to try and focus most of the dialogue today for things that relate to the smaller firm. As Nikki mentioned today, we're really going to talk about mergers and acquisitions of accounting firms with a mind towards what are the roadblocks to avoid so that you don't make the mistakes that we've seen and that we've made before. You know, after 24 years and being involved in over 700 closings of accounting firms, we've made mistakes. We've seen a lot of people make mistakes. And we try not to make the same mistake twice. So the bigger screw up you are, the smarter you get. And hopefully we'll be able to help you avoid some of those headaches and share a little bit about what kind of marketplace is out there and what can we expect in the near future. I never like to turn a CPE event into an infomercial, and I'm not about to do so now. But I do think it's important to know a little bit about the speaker. For 24 years, the only thing I've done is help accounting firms buy, sell, merge with each other, partnership agreements, internal succession, all those types of goodies. I've been listed in one of the top 100 most influential people in accounting, and I do a huge amount of work with the AICPA on this stuff. So that's enough of the info commercial. These are some of the team members. Again, I just had that pop up. Let's get rid of it. And these are just some of the team members, more propaganda that you could all look at a later date. So let's talk about mergers and acquisitions. And the first thing is, a lot of people come to a session that I'm teaching in hopes that they're going to walk away with every single nook and cranny of information that they'll need. I always like to start off with tempering that a little bit by reminding us all that if there's 50 things we need to know about making a deal happen and work, the smartest person in the room is going to think of 35. My goal today is going to get us deep into the 40s. But the uniqueness of our profession, I could show you 4 accounting firms with the same amount of partners, the same amount of revenue, even the same amount of net, and there may be nothing else in common with the practice. So this uniqueness of each practice makes having a black and white cookie cutter types of molds not a realistic thing to do. But there are parameters that things fall within, and let's take a look at most of them now. First, when someone's starting to look into a merger, whether they're the mergee or the merger, for the most part, these mergers fall into 2 categories. The first one is a firm seeking growth. It could be growth of niches, growth of talent, growth of revenues, growth of marketplace. Could be all sorts of different permutations of growth. But that is the main goal. For others, it's to solve a headache. Now, not all problems are bad problems. For example, I have a firm recently in our Chicago office that came to us. They were very successful in doing something that very few firms have been. They developed a significant amount of young talent. Now they had a lot of excess capacity. They wanted to make sure they kept these people busy, gave them a chance to advance. So they were looking to make an acquisition. Sometimes it's for, as I said, many good reasons. But there's got to be, when I say a problem, maybe we need more staff. Maybe we need a bigger platform to service things on. But you've got to know your reasons. And the reason I suggest it's so important to understand the reasons of why a merger is what the goals are, is because it helps you determine the right firm to speak to. So if I know that, for example, my problem is succession, then I know I need firms that have capacity. If I know my problem is something else, it helps me align what type of successor or mergee will fit those goals. So you should know your reasons, and you should know what the firms you're speaking to reasons. Let's spend a drop, though, before we continue on to these roadblocks, to get a little bit of a dialogue about, is it a buyer or seller's marketplace? What's going on out there? You know, for the first 22 years, 23 years I've been doing this, it was always pretty much the same. It was always a significant seller's marketplace with an exception I'll share in a moment. That's starting to change a little bit, but not dramatically in most regards. If you're a small firm, as most of you on the phone are now, and you're in a densely populated part of the country, it always has been and it remains a seller's marketplace. Now, that's not to say values haven't come down over the last bunch of years. They clearly have. But there is no, it hasn't been a situation where it's suddenly a buyer's marketplace. And there's reasons for that. When someone says that I've got $500,000 of revenues and I'm ready to give it up, there's a ton more people wanting to make more money than make less. In addition to that, when you have a small practice, a $500,000, $1 million practice, there are many accounting firms that could absorb you into their infrastructure with nominal increases, if any. Conversely, when you're $15 million, nobody can do that without significant changes. So if you're a small firm in a densely populated part of the country, it's still, and what most likely will be indefinitely, a seller's marketplace. Now, with the baby boomers aging, supply and demand curve has changed somewhat, which is where we're also seeing values go down, but the demand is still pretty strong. If you're 3 hours outside of Boise, Idaho, you might be in some of the most beautiful country among some of the finest people we have in the land. but you also might be in an area of the country that has one accounting firm every 3 zip codes. Once again, supply and demand takes over. I was teaching a session. I ran the AICPA Succession Summit a couple weeks ago, and a gentleman who was in a very rural area said to me that he would never buy any of his competitors' practices because if they went out of business and retired, there'd be almost no place for them to go but to him. So that's where I'm sorry, my screen keeps popping up and I got distracted. That's why in those areas it's a buyer's marketplace. The one place it's changed the most are the small regional firms. Let's call them $3 to $8 million firms. Look at an area like Boston. Boston has over 40 firms between 3 and 8 million. Yet they only have 4 independent firms large enough to be their successor. And although most of those 40 probably think they have the talent to execute an internal succession plan, most of them will find they can't. And when they go to merge up, it will be very much a buyer's marketplace. The larger the firm, most likely the larger the successor must be, and numbers start to shrink. There are 45,000 accounting firms that are members of the AICPA. So when you take away the top 100, and then you take away the next 100, that would bring you down to about 10 million. And there's the 44,800 of us. So the larger the firm, the more challenging it will be and has already started to become for those practitioners. So if I'm looking to be a successor firm, what are my competitors doing that they're getting the better merger opportunities? It's really the first thing people will ask me a lot is, how do I find a seller? How do I find a mergee? Well, one thing that obviously the first step a lot of people choose is to look to firms that they've had a relationship with over time. Maybe it's people they even sent referral work back and forth to each other. Some will hire an intermediary, whether it's a consultant or a broker, to open the door. Sometimes word gets out. Hey, this firm the game is afoot on this firm. So obviously that's a way. Some interesting approaches I've seen some pretty aggressive firms take recently. One was they made offers to get people's attention. They literally reached out to managing partners in firm sizes and areas that they were looking for and said, listen, I have some strong financial position. I'm looking very hard to bring people in and grow. And I'm very prepared to put you in a position of making more money day one, and for those who have succession, getting paid for their years of sweat equity. There were people throwing some pretty strong stuff out there. Not necessarily numbers, but concepts. Also, there were actually accounting firms that have created their own marketing campaigns to do a special search. For example, there's an accounting firm I know in Philadelphia that went through the local CPA directory of all the members within a 30-mile area and actually did a mailing campaign, followed up by phone calls, offices, to sit down and talk to people about the potential of doing some sort of merger. I often laugh when I'm teaching a CPE event, and it's about how to value a practice or internal succession planning, how the gray hair sit down and all the young black hair comes and looks for the gray hair to sit next to. So networking at these types of CPE events and things like that is another way of developing these opportunities. But once you've identified someone, what do you do next? See, this is where some of the people that are very successful in making deals happen. And then there's people you talk to that say, well, we've been speaking for 2 years and we're still working on it. Oh my God, if you're speaking for 2 years, there's nothing there. You should have known that by now. So once you're in the door, you need to move fast. Now, I don't want that to sound like we're going to rush. There is a big difference between rushing and keeping the momentum going. Right? There's a lot of reasons that time kills all deals. We hear it all the time, but we don't hear enough about why. First of all, if I'm the seller and you're the buyer, or I'm the mergee and you're the merger, we couldn't be in more adversarial places. I want to get paid the most, you want to pay me the least. It's a very challenging situation. So the longer we tend to talk, and the longer we negotiate, the more likely these adversarial positions will come out. Many times I've been in a situation where a client will say to me, I don't care if they want dimes for nickels, one more change and I'm out of here. So it's important to keep it going. Also, the message that it sends sometimes is very challenging. This past October, around October 6th or 7th, I called up one of my smaller regional firms. They were in dialogue with a $2 million firm that was looking to merge in. And the $2 million firm said, listen, I really would like to see their employee handbook. We already had been down the road a little bit in this deal structure, and they asked a very lucid question. They wanted to see the handbook so they could start comparing where some of the perks, benefits, and rules for staff might be different, so they could start planning with me how to overcome them. When I called up that managing partner, he said to me, Joel, you know, it's October 6th. We got the October 15th deadline. Then I'm going away for a week. I promise I'll get it back to you at the end of the month. So I said something to him. I said to him, do you have any clients that pay you $75,000 or $100,000? He said, you know I do. Why? I said, this firm is $2 million. They have the potential to be your largest client. Would you tell one of your other clients that something on your computer that you could stick to an email you're going to get in 3 or 4 weeks? He got very annoyed at me. He said, you know, that's not fair. They're apples and pears here. One's a client of mine, one's a deal. I said, but you got to understand, there is nothing more important on a seller or mergee's desk than this deal. These are lifetime decisions. These are decisions that are much more emotional than financial. And when you delay people, when you don't pay attention to them, and they don't, quote unquote, feel the love, most likely they're going to ultimately feel one of two things. Number one, this person's so busy, how can they handle more work? This is a mistake. I shouldn't be selling them or merging with them. Or number two, this isn't a priority. Either one of those messages is a horrible message. Time kills all deals because you need to keep the momentum going. Everybody still needs to feel that this is a priority, and it should be a priority. You also have other issues with time. The 13th time someone reads a contract, it suddenly means them the first 12 times. You got to avoid that type of thing. And when you have long negotiations, you can almost expect competition to arise. If I'm thinking about doing something and I've spoken to my partners and I've spoken to my attorney maybe, I've spoken to a consultant maybe, and then suddenly somebody thinks of another candidate for them or whatever, once they're in the market, they're in the market. You want to keep that deal for yourself, or you want to know it's not for you. Doesn't mean you should do the deal. Sometimes the best deal we do is the deal we don't do, but we need to stay focused on it. So what I've created here is approximately 7 or 8 steps that you can follow as a sequence from the beginning to the end to make sure you keep the momentum going in your deal. Step 1, of course, is our introductory meeting. Now, at that introductory meeting, there's 2 things you want to be able to do. The first one is sharing your goals, explaining to them what success looks like. Now, think of your goals in many terms. There's the financial part, there's the professional part, there's the personal part. And most deals have certain, what I call, must-haves. Maybe a must-have is, I must have equity in the successor firm if it's an upstream merger. If it's, I'm stuck on a lease that I signed personally, you must retain my space. A terrible must-have, and the most overrated thing in the world is the name of a firm, by the way, but some people will say, I must have my firm and my name in the firm. I would recommend to them that that's not needed. That's not what retains clients, and we'll talk about that in a little bit. But the point is, share your must-haves. Now, you want to keep roadblocks to a minimum. So what I really want everybody to do is think about what's a must-have, what's a strong preference, what's a preference. The more must-haves you have, the more challenging it is to get a deal done. But by sharing them day one, it's critical, because if it is a must-have and the other firm doesn't agree with that, better now to find it out in that very first meeting than invest a voluminous amount of time to find it out later. Sometimes because someone's must-have they feel is going to be challenging, they want to put it off, discuss it later. And that's the exact opposite of what you need to do. So the first thing in a meeting that you're doing is sharing information on must-haves, on goals. The other thing you should be doing is giving them generic information about your practice. We're not at the due diligence stage, but there's great forms. If anybody would like one, they could send me an email. I'll give you examples of them. There's all different forms that aren't brain surgery, aren't time-consuming to fill out, that a firm could give the other firm a good idea of what they have. It's a pretty simple sheet. This is my gross revenue. This is how many partners. This is my staff. This is what I pay the staff. This is our hourly rates for the staff and partners. Hey, this is how many business clients I have. This is how many 1040s I have. This is the revenues that come from that. This is the software I use. Hey, these are my 5 biggest clients, but not by name, by industry. Oh, by the way, I do 10% audit, 20% comp, 40% tax. A little bit of this. Most of this stuff is right off the top of your head. But it's very important to share this metric information also. So now I'm at a first meeting, and when that meeting ends, we should have a really good idea about the nature of each of our practices, the goals each of us have, and the must-haves, if any, that are there. Very often we're able to discover that there's no need for a second meeting. But if we get past all 3 of those things, then we're probably well down the road without investing a huge amount of time, because if I know what you have and I know what you want and I'm comfortable with that, we've created a foundation that justifies continuing the dialogue. Now, once we've had those 1 or 2 meetings, sometimes 3, we want to make sure we're comfortable and we've shared all this. I go right then and there to a non-binding offer. Now, I know this will sound strange. We've done no due diligence. We've had 2, maybe 3 meetings, and we're already going to this non-binding memorandum. Well, let me tell you, in 24 years and being involved in over 1,000 times where there's been a due diligence performed between the deals we've introduced and the deals we've consulted on, I could count on my fingers, maybe need a couple of toes, where there's been an epiphany in due diligence. It's an important thing to do, but we're accountants. We build it and collected it. We tell people what it is. We know another CPA is going to make sure that that metric information we shared was accurate. So what I expect to do at this point in time is to assume that the information been given to me is the gospel truth, and now I know all their goals, I know their metrics. I should be in a position to say, okay, here is how philosophically and financially I see these firms coming together. If it makes sense, maybe we need to tweak it. It pays to keep going. If we're on the same page, now it makes sense to go to the next step, due diligence. Now, I know a lot of people feel that due diligence needed to occur before the offer. Let's understand, due diligence is a very invasive, time-consuming process. Not only does it take time for both people, but I'm sharing confidential information. I probably need to do it during off hours because I don't want my staff being curious to what's going on. So there are a lot of issues here to get that done. And I cannot tell you how many times when I first started doing this in 1990, accountants would have 5, 6, 7 meetings, and the last 4 meetings were just an inglorious continuation of the first 2. They'd go in and do due diligence and see it was pretty much everything that they thought it would be, then make an offer that the firm didn't accept. What a horrific waste of time. None of us are selling products. We're all based on our time. This is not something that should be wasted. So now we're at if we have an oral agreement, non-binding, we go to due diligence. Now, I don't believe anybody should have to go in on a search and destroy mission. Each firm should share with the other a list of what they'd like to see. There's lists and things like that on our website if you'd like to see articles that we have there. There's AICPA has suggestions on what to look for. But I also want you to think of due diligence almost in 3 stages. Some things that are asked are readily available. Someone asks me for a P&L, someone asks me for certain tax returns. That's on my computer. I can knock it out to you in one email. There may be some things that take time for you to organize, and there may be some things that we need to come into your office to see. Again, to keep the momentum going, not to rush, just to keep the momentum going, I like to get, if you have things ready to email it. Let's not wait for everything to be ready at once. We can send them out in pieces and get this done. Now, if we've met each other, we've shared our goals, we've made a non-binding offer that was accepted, and due diligence checks out, we're kind of there. So now we've got to sit down and plan a proper transition. What are we going to do to maximize client and staff retention? What message are we going to send? And again, we'll talk a little bit about that at the end of the presentation. And now is the time to document and close the deal. If you're going to utilize an attorney, I would suggest you wait till this point in time. And I often get asked, what's the difference between the attorney that makes the deal and the attorney that breaks the deal? And I've always answered that you're the CPA. You're the experts in dollars and cents. You've made valuations. You've come to a conclusion this is a business deal that makes sense for you. The attorney that wants to renegotiate this deal is the attorney that's going to cost you a fortune and blow the deal up most of the time. The attorney that says, hey, you know what you're doing, you're confident, so my job is to memorialize what you've agreed to and protect you in the contract, is the attorney that's going to get the deal done. So that's an overview of the 7 or 8 steps that we go through in order to keep the process going, in order to be respectful of each other's time. Now, some other things to think about. If I'm the successor firm, I know a lot of successor firms spend too much time telling the mergee or the seller about their headaches and why this should happen and why that should happen. It's not about you. The person, the seller or mergee, it's really their only concern is what's in it for me. You need to stay focused on their goals. It doesn't mean you should do someone a favor and be Santa Claus and throw them money. What it means is you need to be respectful of what's their thought process is. Now, that's, again, you're going to make an offer based on what works for your firm. But spending all that time talking about you instead of what their needs and what we need to do to keep the client, that's important. And once we get to a point where they see that you're vested in them and believe in the mergee or seller, they'll tend to become more to your side of the ladder and work more shoulder to shoulder than against each other. Don't forget, during these meetings, be really, really clear about the goals that you're sharing. I think it's very important before you even start a dialogue that you have an idea of what success looks like. If my deal is succession, I should say to myself, you know what, I want to work X amount of years full-time, Y amount of years part-time. Here's how I see my role. Here's how I see us retaining the clients. I should have a picture in my mind of what success looks like, and I should share it with them. And you want to avoid problems later? Be honest about the pain. I'll give you an example. Almost every deal is going to have some level of pain that someone's going to have to go through because change is the dirtiest word that's not 4 letters. Nobody wants to change. And most of these deals involve some level of change. All of these deals involve some level. Not necessarily ridiculous quantities of change, because if your deal requires wholesale changes, neither of you should have done it. But your deal's going to need some changes. Share what they are. Let me give you a great example. A real good firm, Witham, Smith & Brown. Bill Hageman once told me that the way he does his merges is the day he meets someone, he explains to them, we have a rip and replace policy. The day our deal's effective, we rip out all your technology and we replace it all. And the first year, you're going to hate me. And the second year, you're going to say, hey, this isn't too bad. And the third year, you're going to say, why the hell didn't I do this 3 years ago, before I did this deal? But he's very upfront about it. By the way, I don't necessarily agree that you do that, but that's secondary. He, right up front, makes it clear this is the pain that you can experience if we're going to do something together. So you need to share those things. But let's keep in mind when we're talking about change, not everything needs to change day one. And before we go into that, let's get our second polling question done, because if you have to listen to this New York nasally sound, you might as well get a CPE out of it. Nikki, can we do our second polling question?
Sure. Our second polling question today is, which best describes your situation? You'll see the options are right there. They include, we are looking into a merger for growth. We're looking into a merger for short or long-term succession planning. We're looking into a merger that combines the above, or we're planning on remaining the same. We'll give everyone just a few more seconds to select their answer, and keep in mind that you do need to complete the polls in order to get the CPE credit.
Yeah, I can't imagine too many people want to listen to me and not get a credit for it.
Okay, it looks like nearly everyone's voted, so I'll go ahead and close it. You'll see the results up there on the screen. It looks like we're pretty well split. 33% is the highest percentage, and that's the one that combines the above, and then pretty even with the other responses there.
Okay, wonderful. So let's talk about change. And let's try and focus on change from two different places, because these are some more obstacles and roadblocks that you can try and avoid and be aware of. Let's call one change behind the door, one change in front of the door. Let's give examples of both. Let's say that I'm merging into a larger firm. And let's say I'm merging with Marcia Miller, who runs Florida for us. And Marcia uses CCH and I use Lacert. And we're going to change to CCH. That's a change behind the door. While it clearly may impact certain staff, it has no impact on clients. No clients care what software we're using. So that's a great example of a behind-the-door change. But let's say that I personally go out to see a client every quarter. But Marcia is going to tell that client they have to go onto the portal. They're only visited once a year, and it's by a manager. That's a change in front of the door. So change in front of the door are things that the clients notice right away. It could be nature of the service, who's servicing them, fees, all sorts of things. Change behind the door can be instituted very quickly. Change in front of the door, generally speaking, needs to be instituted very gradually so that clients are retained, the staff is retained, and there's a comfort level with what's going on. And again, we'll share a little bit more with that in a little bit. One of the things that when I think about change, I always think about that old bigger is better. And in most cases, in mergers and acquisitions, bigger is better. But bigger is not always better. Better is better. So there's certain types of mergers that you got to think about from the size perspective that make no sense. Very recently, in our California office, I spoke with a potential mergee person looking for succession. They had a small $500,000 a year practice, and they were asking that maybe we should target for them some of the regional firms in their area. And I asked this gentleman, I said to him, you've got a small practice. Is it mainly compilation write-up tax? He goes, yeah. I said, do you have a lot of clients you're on second and third generation? He goes, yeah, how'd you know that? I said, when your clients come in, do you see them during tax season? He goes, of course. Do they come in to get their tax returns done, or do they come in to tell you about their grandchild or their daughter? He goes, of course. I said, well, you see, your practice is a hand-holding family office type of practice. It's going to be very challenging to take that practice to a regional firm whose partner is never going to give them that time for a $400 tax return. There's certain things that make no sense. So you have to look at the culture of this firm, not just the fees, which were also very important. Look, if your clients love your fees, raise them. They should be able to live with your fees. But for a firm's going to have to say, hey, you were dealing with a partner, now you're going to deal with a junior. You were paying me X, now you're paying me Y. These are very challenging things. So that's why sometimes you can't take a small firm into a regional. Maybe you take a 1 to 2 partner firm into a 3 to 6 partner firm, but probably not a 50 to 60 partner firm. There are exceptions, of course. The other things that I always get a little concerned about are people that, when I ask them their reason for merging, it really translates to overhead reduction. Joel, I have a lot of space, and I figured if I merged with someone, we could fill up that space and maybe share the secretary and share the software. I always say to them, I don't like to talk us out of a fee, but that's the worst reason I've ever heard for a merger, and I hear it often. You see, if your only goal is overhead reduction, you could live with someone and not marry them. You could sublate that space. You could share overhead with somebody. But a merger is a marriage, and we spend more waking time with our partners than our spouse. And to suggest that's the foundation for a merger is just not enough. It's just not a strong enough foundation to work from. One of the other problems sometimes, especially some of my larger firms have, is usually the larger the firm, the lower the profitability. So if I'm a $10, $20, $30 million firm, I'm probably operating 1/3 labor, 1/3 overhead, 1/3 profit. If I'm a 2-partner firm, I could be netting anywhere from 33 to 65%, especially if we're working partners and we don't have a lot of staff. And that doesn't make one practice better than the other. In some ways, I'd rather make 33% of $10 million than 50% of $500,000. But the bottom line is that what happens sometimes when that smaller firm goes to merge up, they sit there and say, well, you know, we don't pay anybody more than, let's say, for argument's sake, 1/3 of the billings that they're managing. Well, it's a non-starter to go into a deal and expect someone to perform the same function they did in the past, bring in the same revenue, and do it for less. That's whether it's staff or partners. So that's a roadblock we got to get by right away. It's very unlikely you're going to convince someone to take a step backwards just so they could merge with you. So that's typically a non-starter. So it's a roadblock to avoid by not even putting yourself in that position. And of course, as a mergee or seller, that might be one of my must-haves. While I'm working full-time, if I'm putting in the same effort, my revenues are coming in, I'm not going to take less. That's a very appropriate must-have to create up front. There are other things that I think people get too carried away about and not realizing that that roadblock that they perceive is not really as strong as they thought it was. A good example of that is where I call the great mystery of billing rates. We had a deal in our Chicago office, it was our D.C. office last year. It was a 2-partner firm. They were doing a little under $1 million. They had no managers, no seniors, no juniors. They just had paraprofessionals, and they did all the heavy lifting themselves. And unusually for me, both were looking to slow down in a 2-stage deal, and I'll explain a 2-stage deal shortly. So they met a small regional firm. Everybody clicked. We get to due diligence, and I get a call from the successor firm, potential successor firm. They said, Joel, we should have realized it day one when the information was exchanged, but we have a problem. They said, this partner's billing rates are only $200 to $2.25 an hour. We're getting $3 to $3.50. We don't think we can do this deal. So I reminded them that the seller had no leverage as far as to leverage work down to managers, seniors, and juniors. So I asked this small regional firm not who's going to be doing the hand-holding. Not who's going to call the clients, but who's going to do the work. They said, well, based on the type of work they're doing, most of the work they're doing, we'd have a senior handle. I said, what's your senior's billing rate? They said 1 1/4 to 160. I said, well, I guess they're getting 2 to 2 1/4 now. You see, the problem is, as accountants, we tend to look at everything on a piece of paper and consider it the gospel. So we saw a partner billing rate at $200,000 an hour. But if we're going to leverage that work down, we'll be able to get a better rate for different level staff. If our technology is better and we're more efficient and it takes us less time and effort to derive the fees, we're going to be able to basically get a higher rate than what it said on that piece of paper. And it could be the opposite. We lost the deal in Texas about a year and a half ago, where 20% of the work that the firm was doing was audit, and when we got to due diligence, we found that one partner handled the audits from beginning to end. And the problem, of course, was the successor firm needed 2 pair of eyes on that for quality control. It would have taken longer time and effort to derive the fees. So you can't look at billing rates and say that's it. You have to transpose what they're doing to your firm, which you'll be able to do in due diligence. When you see the type of work being done, you should be able to know what time and effort and what level staff you'd put on it. The same thing comes up when I hear about profitability as a roadblock. Well, you know, they're not as profitable as I am. And when I tell them that their profit means nothing to me, everybody looks at me like I have 3 heads. I have kids to do that. I don't need clients to do that. So what I shared with them is an example of why you can't look at the seller's profitability alone. I gave the following example. I said, let's say 5 years ago I had a $300,000 practice, and I was running it out of my home. My wife, Kathy, answered the phone. We handled everything together. My net was what, 85%? Then we were tired of people knocking on the door, so I took an office. Kath didn't want to go, so I hired an office manager. And I decided to play golf on Wednesdays with the dentist. Why they play Wednesday, I don't know, but I wanted to play golf with them, so I hired a per diem for Wednesday. Now I'm netting 40%. At which point in time was my practice worth more to you? Irrelevant. My profitability is it's the successor firm's profitability. So again, sometimes we create these roadblocks based on fictitious numbers, or we forget to look and assume that, hey, they're netting 50%, we're going to net 50%, but we have additional quality control levels that they didn't have. So it could be a roadblock for either side of the table, on the good side or the bad side. One of the true things that you have to keep an eye on are these cultural differences. Partner billable hours. For example, usually the larger the firm, the lower the amount of chargeable hours per partner. Some firms have issues that are tough to get together with other firms. For example, there are some firms that say you can't be an equity partner if you're not managing $1 million book of business. And if equity is mandatory for me as a must-have, and I don't have $1 million book of business, that might be a problem day one. Some firms are very big marketing, some aren't. I've had deals that became soured during the process over dress code, where one office was a suit and tie office and the other was very casual. There are certain types of cultures that are hard to mix. If I'm doing value billing and you're doing time and billing, if you're doing retainers without caring about the time, and I'm very time sensitive. Also compensation. If partners at our firm are making a different level of compensation than partners at your firm, many times compensation can be a proxy for culture. So these are some things you need to look out very upfront about. And they go on. For example, most large firms today are getting away from equity being a powerful factor. Most regional firms at this point in time have diminished equity to almost no meaning at all. Here's a great example. Just a couple weeks ago, I was speaking at the Accounting Today conference, and on the way flying down, I was reviewing a partnership, actually a membership agreement of an LLC that's based in Boston. And the way their firm worked was one partner, one vote. So if I have 80% or 8% equity, I have the same voting privilege. Profit distribution in that firm worked as follows. 1/3 of the dollars available to be distributed were distributed to all partners equally. One was based on a very anal formula, an accountant's dream of chargeable hours, realization rates, but very long list with different weighting things. And if I was in the audit versus the quality control versus the tax, I had different goals, kind of a neat system, very objective. And the last third was based on a compensation committee that subjectively rewarded a share of profit to people they felt deserved it. But again, if I'm 8% or 80% equity, it didn't affect my compensation. And the buyout is not based on a multiple of revenues times my equity interest, but the way they did their buyout, which is very common in large firms, is they take an average of your last 5 years' income on an accrual basis. They multiply it by 2.5. Most are between 2 and 3 these days. Pay that amount over 10 years on like a K1 with plus capital. But my point then is their buyout had nothing to do with equity. So firms that have compensation buyouts or have very little power in equity are very challenging to deal with firms that have a buyout based on equity ownership or very equity driven. Sometimes you can't overcome it. One of the rules of thumb in a lot of these things is if a partner is getting out in the next 5 years or less, most firms can treat them differently. They can create an exception for them. But if you're going to be there for 10 years, you kind of have to hitch your wagon to the way the firm's operating. So average net income per partner is very different. Hey, that's challenging. But in firms that equity isn't that important, it's not as challenging. Too many equity partners for your criteria. That used to be a 10,000-pound gorilla for me. Take the example of the 3-partner firm doing $1 million, where 2 guys owned 45% or 2 gals, and they basically gifted someone as a way of retaining them and made them a 10% equity partner. They're 10% owner of $1 million. Is it likely that I'm going to be able to make them an equity partner in a successor firm? Probably not. A mandatory retirement age is a big problem in many firms. But again, even if I have a mandatory retirement of 65 and you're 66 and want to work 3 more years, we could probably get around it by you being a non-equity partner and deferring your buyout until the end of that period of time. One of the big problems that also we run into a lot that we have to overcome are types of capital contributions. Most of the time, if you're going to merge into a firm and you're going to have equity, you have to have capital. Now, fortunately, in most cases, you can simply contribute your accounts receivable and WIP, and that usually will cover it or get close to it. But a lot of times when a lot of you on the phone today are looking to admit new partners into your firm to build your internal succession team, it's very hard to say to somebody, hey, I'm going to make you a partner, and now you're going to make less because you have to make this capital contribution. So again, there's ways to overcome it. Here's a couple of them. Hey, you're going to make more, but on your profit distribution, 50% is going to come back to the firm until you hit your capital requirement. Or, as we just helped somebody in our Kansas City office, it was somebody in dollar practice who just admitted someone as a partner. They said, hey, on all revenue over $1 million, you're 50-50 with me. But before that first $1 million, I own 100%. And it avoided needing a larger capital contribution. So these are some of the headaches that you need to make sure you're on top of before you get too far down the road. I would say to you, though, without any hesitation, and I've probably been involved in more mergers and acquisitions of accounting firms than anybody you'll ever meet, it is very rare that the financial terms are a blockade to making the deal happen. Listen, if it's a buy-sell, nobody's going to buy your practice to lose money, and you shouldn't be Santa Claus. If it's a merger, like I said, nobody's going to do the same thing they did before and make less. So working out the numbers, as much as people want to make it into brain surgery, really isn't. The problem is the emotional side of it. You know, especially for us smaller firms. Right now, we're master of our own domain. If it's Wednesday afternoon and the weather's nice and I want to play golf, I play golf. If Sunday the big football game's on but I got to do work, I do work. But having the accountability to merge with a successor firm and feel like I'm going to be their clock-punching employee is very challenging. When you're master of your own domain, it's very hard to go into a bigger sea and be a smaller fish. So you need to think about that if you're the successor firm. You've got to respect that. You've got to know what's in it for them. They don't want to be swallowed up. They're afraid you're going to bring them in and cherry-pick their clients and kick them out. They're very concerned because of most succession plans, the payout has contingencies based on retention, which are appropriate most of the time. But they're nervous about accepting that risk. Some get crazy about their name in the firm. As I said, that's not really what it should be. And I got to tell you, there's a lot of things that I just think are non-starters. I remember valuing a firm for someone in New Jersey not long ago, and they said to me, son, if I worked 4 more years, I'd make that same amount of money. I said, well, that's just a non-starter. Heck, I do a good living. Pay me 80% of what I make for the next 5 years, and you can have my business. You don't make more money selling your business than owning it. But if someone has that mindset up front, that's a problem. So what you need to really relate to are these emotional issues, which are much more powerful than the financial ones. When it comes to internal buyouts, there's a lot of things that you need to think about. And these are some of the roadblocks I've run into when we're buying out partners. I want to start with a premise. On the phone right now are over 4 dozen, almost 5 dozen accounting firms. Actually, even more than that. My math is not as good as it should be. But at any rate, the bottom line is there's probably been hundreds, maybe 1,000 plus people that cumulatively all of you have helped make a decision about buying a business. That's what you do with a lot of your clients. How many times have you ever said to one of your clients, I've reviewed everything, done a thorough due diligence, I've done a plan, you got to do this deal, you're going to break even, maybe lose money for 5 years, it's fantastic. None of you. So then why would we tell our partners that? You see, if we're going to motivate people to be our successor, they should make more money. That's what buying a business means. So if we're going to operate under that premise, then we need to figure out how to value our businesses correctly. Now, large firms will do buyouts on a multiple of compensation. Smaller firms will do buyouts based on a multiple of the revenue times their equity interest in the firm, or if it's a sole practitioner, multiple times their times their revenue. And by the way, I teach a class on valuing a firm. Well, look at one of the articles on the website. Multiple is just a small part of the equation. It's not where you begin or where you end. It's just part of the equation. But at any rate, whether you're doing a buyout based on comp or equity, it's got to work. So here's a litmus test you can apply to make sure that you don't have a roadblock that's going to be unovercomable. Let's say as a partner in a firm, I'm making $300,000. Let's say that we agree it's going to cost $100,000 to replace my labor. Well, that leaves $200,000 left in the firm. How much of that do I get as the buyer? How much of that do you get as the seller? And for how long? Because based on that premise, the buyer's making more money and the seller's getting paid for their years of sweat equity. If your buyout fails the litmus test, that someone's in a negative cash flow when they replace your salary with the purchase price plus the cost of labor, who's going to do that deal? So we need to make sure that we give our partners a chance to prosper. Now, if you're going to have partner buyout and it's going to have no retention period, you want to avoid a big roadblock, make sure you have a notification requirement. A classic notification requirement's a minimum of 2, sometimes 3 years. So 2 years before I want to slow down, not necessarily retire. I might want to work 10 more years part-time. But 2 years before I slow down, I've got to give notice. And then we should have a written plan. What are we going to do during those 2 years to transition the relationships so that when I retire, the clients are retained? And there's penalties for not giving 2 years notice. Some people lower the value. I don't. I just add a retention period. This way, if nobody's lost, why should the retiring partner be penalized? But if clients are lost because they didn't give you an adequate transition period, they should bear some of the responsibilities. I see a lot of times where people also go about succession with what I call a number count. We're a 4-partner firm. We have 2 partners going to slow down over the next 5 years, but we got these 2 great people we're going to promote. Then I find out the 2 people retiring handle the audits, and one's the administration and managing partner, and the 2 people they want to promote are in the tax department. It sounds silly, but it happens a lot where people are replacing the body, not the role. You got to do the opposite. Now, because most of you on the phone are small firms, very few of you have what we call brand loyal clients. Most of you have partner loyal clients. Remember, they don't even know enough to measure. 99% of your clients don't even know if you're competent or incompetent, because if they knew that much to measure your technical skills, why are they paying you to do the work? Unless there's an audit involved, they don't know. They trust you. And when you have personal loyalty, it's a fabulous thing, and it can be transitioned, but it takes a little bit more time. So a lot of partnership agreements are now requiring longer notice for partner loyal clients than brand loyal. Vesting periods that someone has to be there a period of time before they can get bought out. And a way to protect the firm is having what we call caps. For example, in the partnership agreement we helped the firm redo in Washington, D.C. after retreat, we put in a 10% cap that in no 1 year can more than 10% of the revenues be paid out to retiring partners. So if the retiring partners were supposed to get paid out over 6 years and it became 7, so be it. They didn't lose the money. But remember, a partnership agreement's to protect the firm, not the partners. Because if the firm doesn't survive, nobody's getting bought out. So these are important things to think about. But I will tell you, of all the things I think about, the most important to me are the 4 C's. Rule number 1, if you don't want to eat lunch someone, don't do a deal with them. Chemistry, chemistry, chemistry. Nothing close to being as important. Again, why do you have your clients and staff? They're comfortable with you. If you're not comfortable with me, why would you merge with me or sell me your practice? That the successor firm should be able to offer a significant level of continuity. If they're going to have to make wholesale changes in front of the door overnight, it's a deal not to do. If our cultures are so vastly different, our staff and clients won't be happy. It's a deal not to do. And I think the C that people don't think about enough is capacity. If I've got a small practice, but I'm putting in 1,500 chargeable hours and 700 administrative hours, and most of it has to be replaced by a partner, can I sell my practice to another sole practitioner who's got a similar sized practice? Even though the cultures and the continuity, everything, chemistry might all be good, do they have the capacity to replace what I'm doing? So it's very important to focus on those 4 C's, and if all 4 aren't there, it's time not to do a deal. And we've got to look at every deal as a fair deal. Both people are going to have to win. And don't negotiate one variable at a time, like multiple in a sale. Well, how can you discuss the multiple without discussing how much money up front, if any, how long is the retention period, how long is the payout period, what's the tax ramifications of the pay? All of these things are part of the package. When you negotiate one variable at a time, you're bound to run into unbelievable roadblocks that avoid you from doing the deal. And when it comes to retaining clients, we'll close with this and then take any questions anybody may have, is the secret to the success of any deal is client retention. If the clients are retained, everybody makes their money, everybody usually wins. So remember, there's 4 fears, a maximum of 4 fears of the top fears clients have. The first one, is the person I trust still there? Is it going to cost me more money? Do I have to now drive across town when they were right next door to me? And for some clients, they get very tied in with staff. And is the staff going to be there? So it's very important you address these things. So you got to address them up front. Hey, I'm still here. The fee structure is the same. The people you're used to working with are still here. We've all in the same community. I just have more backup, more support, more services to give you, yet operating under the same fee structure. I'm going to de-emphasize change. I'm going to emphasize continuity. I'm not going to talk about the loss of my firm. I'm going to talk about the gain of the successor firm. On our website, there's a drop-down called Resources. You don't have to sign in. Our technology doesn't let us know you're even there. But there are some wonderful, there's about 70 articles, how to value a practice, structure a deal, a two-stage deal, transitioning clients, what to look for in due diligence. There's lots of case studies, free reports. Help yourself to take a look at them. But let's do our last polling question. And if there's any questions that came in, Nikki, I'll be happy to address them. But let's give them their last polling question so they can get their CPE.
All right, here's the final polling question for today. Over the next 5 years, what percentage of your partners will be reducing their time commitment to the partnership? Your options are none, between 1% and 25%, 26 to 50%, or greater than 50%. So I'll let everyone take a moment to answer. We didn't have any questions, Joel, so I think we're all set after this.
No problem.
I just wanted to remind everyone that once we're through here, a brief survey will pop up. Joel mentioned the great resources that we have on our website. And in that brief survey, you'll have a chance to request a PDF of today's slides. And you can also request specific articles that Joel recommends that are relevant to today. So if you would take a moment to fill that out, and then when I send you the email for the CPE evaluation link, I can also send you links to those resources as well.
And most importantly, all keep our fingers crossed, because the wonderful woman speaking to you all is going to pop a baby out any day now. And we should all, we're thankful that you were here to help us get through this, but go have a healthy baby.
Thanks so much, Joel. All right, I've closed the poll, so I think we're all set for today unless you have any final words.
No, thank you all for tolerating us, this nasally sound of mine. My cold in it was worse than normal. But remember, a lot of times someone will come up with something they wish they would have asked a day or a week from now. Don't hesitate. Shoot us an email. Give us a call. Just because the session ended doesn't mean we can't answer a question. Everybody have a great day.
Great. Thanks, Joel.